And let me just
Well, hello, and a very warm welcome back to the Andrew Eborn Show. And what is a special pre-budget edition? Tomorrow, Chancellor Rachel Reeves will deliver Labour's first budget in 15 years. It's widely billed as the toughest since the war, with up to £40 billion of tax rises and spending choices that will shape Britain for a decade. Few people a better place to dissect what's really coming than my guest today, Vicky Pryce, a regular on the show. She's the former joint head of UK Government Economic Service, a past chief economist at the Department for Business, a board member of the Centre for Economics and Business Research, and better than all of that, the author of the acclaimed new book, Mismanaged Decline: How Britain Squandered Its Economic Potential. Vicky, welcome back to the show.
thank you very much. Can I say an ex-board member of CBR, still chief economic advisor there. So thank you for that.
That's very good,
Um,
but still the author of this brilliant book.
oh, well, here it is. Here it is. I just thought I'd show it. It's all about why we got to the stage we're in. And of course, the budget, as you rightly have been pointing out, is going to be quite crucial in terms of seeing, is it going to get us out of that decline, which we label in the book as mismanaged decline over a period of a few centuries, or is it going to simply perpetuate where we are?
Yeah, and economists are widely anticipating, what is it, 20 to 30 billion pounds in tax rises to plug this fiscal black hole, potentially hitting capital gains tax, inheritance, and even a new levy on high value homes. Do you see this as a pragmatic reset or a politically toxic gamble that could stifle the investment boom Labour promised?
Well, it's really interesting what's been going on because we were all led to believe that there was a huge gap, much bigger than even the one you're suggesting, up to 40 billion possibly. And that was because the Office for Budget Responsibility, which is the body that does the sort of fiscal forecasting in terms of looking at whether some of the economic expectations are in line with the fiscal policies that the government is putting through, and therefore what it may actually mean in terms of how much you need to borrow and whether you meet the targets. There are fiscal rules out there, and those rules, which I mean, they're not enforced by anyone except the government itself, and there are rules that can be changed. But this particular government has fiscal rules which I've borrowed a little bit from before, but basically what they're saying is that you only borrow to invest, and over a period of time, your current spending, in other words, everything the departments do, whether it's on welfare or anything else, that is covered by revenues, tax revenues, or any other revenues you may have. So that is the real problem, and those are the rules which the markets are following in terms of looking at whether the government is meeting them. And there is serious concern by the government that if they show any deviation, if you like, from those rules, the market will punish them by making them pay an awful lot more for the borrowing that the government has to do, and therefore, yields on bonds will be very high, and it means that the cost of servicing the debt is very high. But we were led to believe that that gap that was there in order to satisfy the markets and in order to meet those fiscal rules was higher than it looks like. Because, as I said, the Office of Budget Responsibility had apparently recalculated productivity forecasts and expected them to be lower in terms of the way they would grow over the period, which meant a lot more borrowing because revenues would be coming down. So just to give you, I mean, this is a big economy, of course. Every 0.1 or 0.1 slower growth in productivity costs about £7 to £9 billion a year in
Yeah.
terms of lost revenues. So you add it all up, and it's an impossible task if you're just running to catch, your tail in a way. And that was really what the markets were beginning to worry about, and that therefore we would have to raise a lot more than had been anticipated originally because this forecast would be bad. And everyone then started talking about raising income taxes, or at least not everyone, but there were hints from the government that that is perhaps what they're going to do, break manifestos. We were all getting used to it. And then apparently the forecasts aren't as bad as that for the economy after all. And therefore we need to raise less. So, you did start off by saying, possibly up to 40 billion, maybe now 30. We still don't know what the reality is going to be when all these measures work through the system that we're going to hear about tomorrow.
Yes, and the Treasury's mantra is always sort of renewal and growth through investment, but the fiscal rules demand debt falls as a share of GDP by 2029-30. If she prioritises capital spending on green tech and housing, what specific cuts to day-to-day services like welfare and local councils do you predict? And could they trigger a voter backlash akin to the 2010 austerity revolt?
We've already seen the attempts to reduce the welfare bill were thwarted really by loads and loads of Labour Party backbenchers, finding that that would be pretty hard to sell to their constituents, so they gave up on that. So that raised the need to bring some more money in because those cuts weren't going to happen. That's why everybody was reworking their forecast and thought the gap would be bigger. So there is that, and there is also, of course, the discussion now and quite likely measure which will happen on lifting the two-child benefit cap that has existed for quite some time now, and that this, if it's lifted, will cost an extra, whatever, 3 billion possibly. So we're talking about an accumulation of things. Not being able to do the welfare cuts before, that was about 5 to 6 billion. This extra thing, another 3 billion, and so on. So you could just add it all up and see that there is a gap, there is a headroom point, the headroom being what you need to make sure you have aside if there is a real problem in the future. And the headrooms for this particular government have been the lowest for decades in terms of what they're allowing themselves for. So the markets will always be looking to see how much of the headroom has she rebuilt by those measures. And because she's going to have to do lots of different things and she can't really cut spending, and you're quite right to be raising this as a major issue. In fact, if anything, we've been hearing there's going to be more spending for the NHS, that benefits will increase in line with inflation, if not more, that the pension triple lock is not going to be abolished, so pension payments are going to continue to be going up, and the disability ones that she was trying to cut won't happen. You just wonder really where she's going to get the extra money from. And what we hear so far is a mix of loads and loads of different small things. Now you're not going to have your income tax increase. It would have been so neat, but just a 2p in the pound increase in income tax would have raised 20 billion, just like that. And that is just from the basic rate taxpayers. Another 2 to 4 billion for each 1p for the 40 plus, and maybe half a billion for the 45 p payers. So those having disappeared from the calculations, it's everything else: gambling taxes, mansion tax, a tax on, or at least reducing the tax advantages of people who have at present taken advantage of what is called salary sacrifice schemes for paying into pensions or buying quite expensive bikes, which the government has wanted to encourage. So there is a lot of that, which people are just sort of adding up and saying, in reality, even if you extend the national insurance contributions payments to a lot more areas in the economy without breaking manifesto rules, or look at VAT, maybe doing various things sort of extended across or whatever, then they may induce a change in behavior. And that may well mean that you're not raising as much as you had hoped for. So big uncertainties, I think, will remain after the budget, even if, as it is presented, if you put all these figures together, you may get to your 20 to 30 billion. But then the question is that going to materialize?
Yeah, and it was rather foolhardy, wasn't it, to make that promise in the manifesto during the election, to turn around and say we're not going to raise income tax and tax the ordinary working folk, because actually they need to do that, as you rightly point out. That's the easy thing, and Rachel Reeves has urged the MPs today to get behind her. Don't cherry pick what's going to come out in the budget. What do you think the reason for that is?
She obviously got loads of people saying that if you break the manifesto commitments, then that's the end, really, of the credibility of the government. But in reality, once you have already encouraged people to think about that, and you thought that because you had a 40 billion gap, say, you were going to be doing this, which was more or less what she suggested in a press conference she held a couple of weeks ago. That's the Chancellor held a couple of weeks ago. And then you don't do it simply because the figures look a little bit better. The Office of Budget Responsibility suggests slightly faster growth and wages rising faster, and therefore you're going to be collecting a lot more revenues. So even the productivity isn't going to be doing that well. But you've already breached the point. So you made it clear that if you needed it, you would do it. I mean, so you were prepared to break the manifesto commitment. So what's the point of not going ahead and breaking it after all? And then you're right, it is the simplest thing. It is also progressive because obviously the way that income tax works, people at the lower end pay less, etc., etc. So you raise more from people higher up, and even though when you get to the very high rates, perhaps the amount isn't that big because there aren't very many people on that rate. But what you have lost now is the simplicity. And what really should have happened is from day one, a reversal of Jeremy Hunt's 4% cut in 2 stages of the national insurance contributions just before the elections, and you would have got your 20 billion anyway, which was there from the very, very beginning. That's why we got a budget of the sort that we got last year, because she couldn't raise that. Also, of course, as I suggested, she's still talking about huge amounts of spending in public services, which is, of course, good news in many ways. Good news for people who work in it, but also good for us if those services improve. However, in order to do that, it puts a lot of strain on lots of other areas of the economy. And we've had a number of departments really not doing particularly well because the NHS has got most of the money going into it, which the government is borrowing additionally. So it is an issue in terms of, do we really at the end get better public services? You've seen what's going on with the police, the criminal justice system, the delays that are there, and so on. But I think what the emphasis is going to be now is we're not going to do the increases in taxes. We're not going to break the manifesto, even though there will be lots of different ways in which the manifesto is actually going to be broken, though perhaps not sort of specifically, but certainly in practice, if you do things like extend national insurance contributions to many more areas, such as, for example, people who rent homes to others, so landlords who don't pay that, or dividend payments that don't have that, then you are actually raising national insurance contributions, for example. But her emphasis is going to be on ensuring that the economy improves in different ways, because obviously these measures are not going to help, particularly in terms of growth. So what she hopes is that through some other measures, such as, which are going to cost her, maybe taking away VAT or lowering it for electricity bills, 5% at present.
And they say that could potentially raise, what, 10 to 15 billion less than hoped if they do that. This sort of...
That's the problem, that all these things, which may reduce inflation, may at the same time, of course, cost them more. And that's the real issue. But I hope that perhaps by focusing on measures that they can do to cut the rate of inflation, the Bank of England might cut rates faster, and therefore you have faster growth. So in a way, you compensate for this loss of revenues because you have faster growth. And of course, lower interest rates are pretty good news for loads of people, including, of course, the government, because obviously if they have to pay less, it gets reflected in the yields. They pay less to service the debt. But it's one interesting thing, though, Andrew, that the reason why it seems, one of the main reasons, why the Office of Budget Responsibility thought that perhaps the gap was smaller, is because the weeks that they looked at in order to base their forecasts on, which also looked at what's going on in the market, but also yields, were the weeks when yields had started coming down and were very favorable to the UK at the time. So, you saw a reduction in the yields, and therefore the cost of servicing debt was going down by comparison to what you had anticipated originally. Well, unfortunately, those yields went up again after. So whether even that 4 billion saving, which we thought was going to be the case, is going to, in effect, materialize, we don't know. But of course, if central bank rates come down faster, then those yields will follow as well. So maybe in the long term they'll prove correct, but whether in the short term this were the right assumptions to make
Yeah.
is a different matter.
Your brilliant book, which I said that I would plug relentlessly throughout the program, which is good. You argue that Britain's stagnation is mismanaged rather than inevitable. You blame Brexit and the weak
Mm.
trade ties for choking productivity. Q3 GDP growth is scraping just 0.1%, and OBR poised to slash the 2026 forecast. What one policy in the budget tomorrow, like skills reform or EU alignment, could realistically add 0.5% to annual productivity growth by 2027?
It's really interesting when you hear what current ministers are saying. They suddenly are parading Brexit as a big issue in terms of what is done to growth. In fact, I think one very senior cabinet minister was saying only yesterday or on Sunday morning that something like sort of 4 to 6% of GDP was lost because of Brexit. And that suggests that if there was a reversal, and there are already attempts to do that with a reset, and our trade with the EU improved, that would make a big difference. It takes time, of course, for that to filter through. But what is worrying at present is, despite all the talks about it, it's moving very slowly. There are concerns in Europe about our contribution to Europe if we go back in, if you like, in inverted commas, in terms of better trade relationships. But the center for the moment around defense spending, where we do, of course, need to spend a lot, but also want to be part of a pan-European effort in this area, and also be involved in procurement and everything else from the UK. We have some strong companies here. But that would, if it gets resolved, make quite a difference. If you look ahead, defense spending will have to be quite high. It should lead, if we do it properly and with Europe, to faster growth in those areas. And we've seen that already reflected in some of our defense companies anyway, in terms of the share price. It's still to be resolved whether they're sustainably higher in the future or not. There have been some hiccups at times. But you do have that as an area of possible growth. Plus, of course, the fact that our trading relations with Europe remain so hugely important, and the fact that since Brexit, our trade intensity as an economy, and we say quite a lot about that in the book, has come down. And in any country or in any region, if trade intensity goes down, if trade gets reduced internationally, we have the tariffs, of course, from the US as well to contend with, then you have less innovation, less investment, and less productivity and less growth. It's as simple as that. And we do talk about that, but we also talk about other periods. And this is really why one worries a little bit about what may happen. Periods of austerity, which themselves led to quite a slowdown in investment. This time is the uncertainty that's doing it. We've seen that from the various trade organizations arguing that this has really affected their decisions. And we've seen it in the data recently. So just look at where we are as of November. Well, in the summer, generally, business and consumer confidence sort of slumped. And data for November, in terms of latest surveys of activity, suggests that manufacturing recovered a little bit after the JLR resumed production of cars after the crypto or cyber attack, not crypto, the cyber attack that they had in the summer, and but just about sort of improving a little bit after months and months of decline, and the service sector, unfortunately, going back down to near stagnation. So those are problems. Construction sector suffering as well, generally. Those are problems that the government has to deal with. The question is, will the budget in any way improve the situation? Will there be more money in some areas, but also will it really lead to the markets thinking, yes, okay, we are dealing with the cost of living, we can reduce interest rates, and people's confidence perhaps improves. Big question marks ahead.
Yeah, no, absolutely. Well, let's look at that business confidence. As you say, it's dipped because of these uncertainties. If the budget delivers the expected employer a national insurance hike or planning overhauls, do you foresee a hiring freeze pushing unemployment above 5% by mid-2026, or will wage growth cushion that blow?
But what we've seen is that hiring intentions have certainly declined, quite significantly. We've seen unemployment go up. It was 5% in the latest 3 months. It's actually higher if you look at some of the individual months. So that's a concern. So young people finding it also very hard to get new jobs. there is no doubt that businesses have paused in this area, waiting to see what the budget will do. But also there is the new legislation on workers' rights, which is worrying businesses. There may well be some discussion about that now, but even the government's own internal sort of appraisal of this has estimated that this will add about 5 billion per annum to costs to businesses. There are some changes perhaps that are going to be made, and there's been some softening of the rules that there may be once it gets properly enacted and then implemented. So there is maybe a chance of things being not so painful for businesses, but we certainly hear that concern, in addition to the quite substantial increases, and we'll hear some more in minimum wage and living wage, and also the intention to, let's see if it happens, to move also the minimum wage or living wage, perhaps, that the younger workers get, the 18 to 21-year-olds, up to the same level as everyone else, would have a serious impact on willingness of businesses to hire young people. So that is a real concern.
The other thing which is emphasised, obviously, the regional divide. Scotland and the North are obviously clamouring for more devolved funding, yet the budget's focus seems obviously London-centric. Drawing on your own work at the CEBR, how might unequal infrastructure spending widen the UK's north-south productivity gap by 40% by 2030? And what targeted fix, like levelling up tax credits, would you urge the Chancellor to include?
Well, that's some of the suggestions you've already made. But the worrying thing is that the cost of bridging the gap. So remember, we had a white paper, levelling up white paper, which involved Andy Haldane, the ex-chief economist of the Bank of England, which made a number of recommendations. The problem is that a lot of that has just disappeared. Not very much has happened. And during this period, of course, with COVID and beyond, what we've seen is that the gap has, if anything, widened. It looked like perhaps it was going to narrow because lots of people moving out of London and going elsewhere, and it was perhaps considered to be better to be somewhere else. And but that move has now been reversed and more, and not an awful lot was spent or has been spent in the last few years in terms of ensuring that connections in the north are well, north of London anyway, improve. HS2, as we know, has been in a mess. I'm putting this politely. There are serious question marks as to whether we should ever have started that, and whether we should not, in fact, have focused an awful lot more on what happens in the north, connecting the cities there. The Northern Powerhouse thing that everyone was talking about hasn't received the money that they expected to have received, which was originally pledged by George Osborne when he was Chancellor. So we have a certain amount of that in the book. And the cost now of bridging that gap has increased very significantly. So even though you could do all sorts of things, as we suggested in also CBR, it's going to be a lot more expensive than would otherwise be the case. And there is a question about whether you really need to disrupt a lot what happens in London, because after all, London is the cash cow. The interesting thing is, because there's lots of people coming in and going out, and there's a lot of friction and unemployment, you have slightly higher unemployment in London normally than you do elsewhere, which is interesting in itself. But you still have high productivity, and you still have it seen as a sort of an ecosystem which has everything in it that encourages firms to come and operate around here. Sorry, I'm talking to you from London, of course. And it's dangerous to cut that off as well at the same time. So the choices of any politician are, do we still want to support London? Which yes, you do. But do we want to expand the rest and in some ways damage London? And the answer has to be no.
No, you're absolutely. I mean, and always sort of say, look, one of the things which you need is you need connectivity for the whole of the UK. Everybody criticises the rail, not least the horrendous expense. I travel quite extensively, as you know, talking around the world. It's cheaper for me to fly to Prague than it is for me to get to Manchester. I go down to Cannes regularly, and that's the equivalent of several trips before I pay for one ticket to get up to Edinburgh. That's a nonsense. Is there something that could be done to make the cost of rail travel cheaper?
One of the announcements that we've had in the last few days is that rail fares are going to be frozen for the first time in 30 years. Not all rail fares, the regulated ones, which account for about 45% of all the fares you pay. So first class can go up. A lot of the rest perhaps is frozen. And of course, it goes back to what we discussed earlier. It's the intention of trying to reduce cost of living and perhaps inflation, and therefore have interest rates come down. But yes, I think our costs are huge. But the interesting thing is that if you look at what goes on the rail front in the UK, and we've got to bear in mind that this happens elsewhere, there's huge subsidies that go to our rail infrastructure, if you like, by which I mean mainly running the trains, but also the rest of the system. And if I remember the calculation since you raised it, I think 23, 24, it was something like 11 billion was raised from fares or thereabouts,
Right.
and another 12 billion was put in as subsidies. So despite the fact we had gone through the whole process of privatizing the rail sector, we were still subsidizing it more than we did before. And now, of course, we're bringing it all back to the government again. So the rail industry is gradually being renationalized under Great British Rail or whatever it's going to be called. And that it's going to have to be continuously subsidized. So you reduce your fares. How are you going to, what are you going to do with the amount you're not going to be getting? Is it going to be paid from general taxation? So this is the worry that there are things that are pleasing to the eye and to the pockets, possibly of commuters. And there's, for some weird reason, the one that's always mentioned is Milton Keynes to London, season ticket holders, who are going to save something like whatever, 300 quid a year as a result of this. But it means that someone isn't paying it. And given that subsidies were already so high, I can only imagine the subsidies will get even higher. So the question is, how do you fund them? And that's why people are talking about freezing for longer income tax and national insurance contributions thresholds. So as you increase wages, many more people come into paying tax in the first instance and then paying a lot more tax once they're in the 40 percent bracket, etc., which of course is helping the government, has already helped the government in terms of revenues. But given that they want to use a lot of this revenues, A, to fund the National Health Service better, and B, to pay the debt or service the debt that has already been incurred. You do wonder, you talked about regional inequalities. A lot of the investment is regionally targeted, which is good news. Public sector investment helped, of course, by private sector. But these things take a long time to have an impact. So in the meantime, you wonder how much more money can perhaps go into those areas, or what tax credits or tax levies or can be changed, amended, or perhaps more in terms of devolution that allows more raising of money locally can happen. But whatever it is, it's going to require public funds.
Yeah, and it's always a balance, isn't it? We sort of say, and we've had many people that you've joined me on the show with people like Charlie Mullins who said they left the UK because the taxation was too crazy and so on and so forth. And it is striking that balance between potentially driving the rich away and ensuring that you've got sufficient funds. What is the right balance?
If only one knew, because a lot of it depends on people's motivations. So once you start giving people the option, of course, of being able to leave if you're here, stuck here, perhaps you can't. You have to pay your taxes, or perhaps you give up work, or whatever. Um, so people can leave. People are nomads in many ways. They can go elsewhere, especially if they have a lot of money. And we hear of very high net worth individuals leaving sort of by the week, and some big surprises. So bank heads or and more, um, and going to low tax areas. And also because the whole non-DOMS change and work done by CEBR did suggest that that if indeed the number of non-DOMs going exceeded a certain percentage, and there's evidence that that's happening, then you're back to square one. In fact, your revenues that you expected to collect start, either plateauing or getting reduced above a certain point. And you just don't know how people will react. You have, on the one hand, all those millionaires, is now, I presume they're all billionaires, saying, tax me more. Well, I mean, my view was, why don't you just pay something to HMRC if that's the way you feel? I mean, or fund something for them that otherwise would have cost us all, the taxpayers, money. So if that's how you feel, but there is no doubt that where that balance is varies depending on the class of people or the types of people you've got in your country. So wealth taxes, for example, were tried in a number of countries and then semi-abandoned. So because that capital is so movable, for example, in France, where they've stuck now to just a property wealth tax, if you want to call it that. They tried it in Switzerland. Well, in Switzerland, you have to get agreement from all the cantons to have this sort of wealth tax, and it varies from place to place. So it couldn't possibly ever work properly. So you've got the sort of human factor, but also the fact that right now some of those fortunes are so much greater than anything we were thinking about before. Then tax can take out such a large part of that in tens of billions, that the incentive of perhaps going, taking it all and disappearing, has increased. And one of the things that the Chancellor has also talked about, or at least someone from the Treasury had hinted, and we see whether it happens tomorrow, is that you tax people who are leaving, not just on the property they sell, which was always the case, but also on all the assets that they then sort of monetize, if you like, so stocks and shares or anything else they may have. Whereas until now, you could just take them without having to pay an extra tax. So there could be a leaving sort of tax that is imposed. A little bit, I think, like what the US has been doing for some time, but not quite. But anyway, so there are all sorts of suggestions to try and capture a little bit more of
But
that.
there's more of a stick than a carrot. It's not an incentive to stay. It's a penalty if you
Yes.
leave.
Yes. On the other hand, for sort of investments, I mean, there's a big thing going on right now in the city. You probably are aware that apparently, anyway, there is a letter sent around by, or a memo or something, or an email or whatever it is. It can't be a letter these days. Maybe it's a text to
Carrier
or a
pigeon,
WhatsApp.
yes.
A WhatsApp. Oh yes, maybe it's a WhatsApp, which is encouraging apparently the financial institutions in the city to be positive about the measures tomorrow,
Yes.
or at least not to be against them. And that we assume must be because a lot of the discussion earlier had been maybe banks are going to be charged a bit more because there had been this 8% tax extra levy that was being put on banks, reduced to 3% some time ago. And the expectation was perhaps it was going to be going up because that's another easy route to, given the bumper profits that some of the banks have been making. Well, it now looks like this may not happen. So the quid pro quo is be nice about the budget, please. And I do remember that that must be happening at various stages because even the Liz Truss budget, there were people coming out, obviously probably brief, saying, wonderful budget, it's fantastic things for the economy. We're going to get growth. Everyone then ended up with egg on their faces. So who knows? But of course, we know that there is the issue of Nigel Farage as his party, the Reform Party, which wants to tax the banks more generally. So it's probably just a reaction to that to get the positive response. But that would have been another easy way of raising money. The other one, of course, just going back to what one should do. But of course, she won't do it because she's so concerned about inflation and getting interest rates down. and therefore getting yields down, etc., 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 is fuel duty, which should definitely have been increased over the last decade in line with inflation, which would have raised tens of billions by now, which would have made such a difference. And she's still not going to do it, even though right now we have quite low energy prices, petrol prices. So it's the ideal time to do it. And quite likely a lot of that would have been absorbed by the firms anyway.
And why won't she do it?
Because there is a lot of motorist anger at anything to do with fuel duty. But of course, now we have so many EVs. Well, up to a point, perhaps it doesn't matter that much. And of course, remember that she is going to try to tax, or at least the government may well try and tax EVs a bit more by mileage, because of course they don't pay this fuel duty. But the rest of us who pay fuel duty, I have to declare, I still have a very old petrol car. There is the concern, has always been, that motorists and also farmers, everyone who uses, depends, if you like, on driving, and also particularly in the rural areas, since we touched about infrastructure where connections aren't that good, people rely on their cars. So that's one of the problems. But I think the main one is that it would put inflation up, possibly. And she can't really do that if she wants inflation down and has promised to tackle the cost of living, and get interest rates down.
Yeah. And anger is obviously an energy. I think the more angry you are, the more she has to listen to you.
I suppose so. I mean, they do loads and loads of focus groups, I think, and that's what they've been doing. And as you know, there has been the CBI conference where just yesterday, where the chancellor, well, anyway, the whole political machine has been accused of getting their communications completely wrong, and the uncertainty that has all created, and there seemed to be some anger in that room, to the extent that I think one of the speakers offered to just do the communications for the government themselves in the future, please. It would be better outcomes as a result. So you can see where we are just before the budget. So quite a lot of anger and concern.
Yeah, absolutely. Well, we're going to be getting you back after the budget to unpack what Rachel Reeves does say. We're going to take a quick break. When we come back, we're going to be looking at the global economy and also plugging that brilliant book a little bit more. But for now, Vicky Pryce, thank you for joining me.
Thank you.